We can give you our opinion about what might happen, but we have to accept the limitations of that. We can look for evidence instead. Markets are going to move very sharply one way or the other based on what Donald Trump decides. And Donald Trump is a very unpredictable man. This is the man who very recently announced they're going to rebuild and reopen Alcatraz the day after Escape from Alcatraz was on the TV. Probably completely unconnected, of course. However, he makes these announcements and he changes his mind quite a lot. So it's very difficult to base investment decisions based on what we think Trump's going to do. But what we can do is look for any evidence we can find of what is already happening and what effect this has already had. So one of the things we like to look at, and I'll explain this as we go through, is business surveys. In particular, things called PMIs, Purchasing Managers' Indices. And all they are is a survey of businesses. They go out to businesses and say, how are you feeling? Is business getting better or worse? Are you getting more new orders or fewer? And what's happening with prices? And what we're looking at here is so-called input prices for US manufacturers. That's the blue line. So essentially, if you're a US manufacturer, what price are you going to have to pay for the kind of raw materials that you then use to make your finished goods that you'll sell a few months down the line? And you can see that blue line, I've circled it here, has jumped up quite sharply. So manufacturers in the USA are already reporting an increase in input prices. The orange line on this chart is US inflation. But what we've done is we've basically moved it back by 6 months. We've lagged it by 6 months. You can see that typically, certainly in the past couple of years, you can look at this point here. Sorry, I'm trying to get the clicker on. We can see here, they've kind of moved up very, very closely together. So if that relationship holds, what we probably expect is US inflation is likely to increase quite sharply in the next few months, essentially. So there's some evidence that that is already happening. Also within these surveys, we've seen that export orders, the companies are reporting that export orders have fallen. This is global companies, but whether it's manufacturing or services, we've seen a fall off in new export orders. And again, that's a sort of future, sort of forward-looking indicator that the economy might be slowing. Now, on this chart, actually, it's probably skewed a little bit by the big dip you can see in 2020, that's COVID. But if we kind of exclude that, you can see that's quite a sharp fall. So that's what we call soft data, survey data. It generally gives you quite a reasonable idea where things are going, but it is noisy because it comes out every month and there's lots of data within it. We have found some so-called hard data as well that tells you something similar, in the shape of the US economic growth numbers, US GDP numbers. Now, the US economy shrank in the first quarter of this year, and that surprised a lot of people. That was, by the way, before all those tariffs were announced. And the reason why is slightly technical, but I'll try and explain it. So if you look across the middle of this chart, you can see the sort of blue line is economic growth quarter on quarter for the USA. For the last 2 years, it's generally been sort of 2 to 3% growth. That's pretty good. And then the bars show that's how that's made up. Now, the reason that the US economy shrank in the first quarter was this big green bar here, net trade, which brought that line down. Now, if you look at the previous quarters, that net trade, the green area, is really quite small normally. So it's quite unusual you seeing this big impact. And essentially what that was lots of people trying to get ahead of tariffs, doing all their imports before all those tariffs applied. So net trade is essentially the difference between the number of imports and the number of exports. So it's a really big increase in imports. And just for technical reasons, the way that you calculate GDP is you sort of knock those imports off the growth rate, essentially. So people say it's just a technical factor. Next quarter, probably those companies won't need to do those imports again because they've already done it. They've sort of brought it forward. So probably that will bounce back. Maybe that's the case. I'll just draw your attention to this bit, the orange bit, that's consumption. That's basically how much goods and things are sold. And that was also quite a lot lower than the previous quarter. So consumption was a bit lower. It definitely was a bit weaker. If the economy is going to bounce back next quarter, as some people say, then that consumption has got to bounce back as well. So all I'm saying is there is some evidence, whether it's hard data or soft data, that the US and potentially global economy has slowed a bit and looks like it could have an impact on inflation as well. So where are we going to go next? This is back in the realms of opinion, I'm afraid. So we don't know where those tariffs are going to end up, but based on what's been announced so far, lots of people have done calculations. Most people think the tariff rate for the USA is going to be about 14%. So that's the red dot on this chart. This chart is from Barclays. They've gone and looked at what the tariffs have been all the way back to 1800, and that's the blue line. So you can see the red dot is quite significantly higher than the blue line. If we sort of draw a line across, actually, that we haven't had tariffs at those kind of levels since before the Second World War. So this is just to say, if things end up where it looks like they might end up, then that really is significant. It is going to have an effect. So, our opinion is tariffs will probably be a lot lower when they're finally sort of settled down than was announced in April. But they're going to be quite significantly higher than they were prior to that. If so, that seems likely to push up US inflation. It's less clear globally, by the way. I'm not so worried about UK inflation because some of this might have an impact, but there are other things that might take the edge off that. In particular, some of the Chinese electronics that have been diverted that are no longer going to the USA have come to this side of the Atlantic instead. Maybe that will help. So it's a bit less clear. But it's important for us in portfolios, US inflation, because what it means is the US Federal Reserve, the central bank, is less likely to cut interest rates if inflation goes higher. And cutting interest rates would generally be good for portfolios, we think. So we might see an increase in new inflation. We might see a slowdown in the US economy and potentially the global economy too. That, as I say, there's already some evidence that's happening. If so, that will probably hit company earnings profits a little bit to some extent. But markets don't currently agree with that because markets have been going up, rallying quite nicely, whilst the economy appears to have been slowing. And we don't think that can continue indefinitely. Hopefully, markets are proved right and the economy is going to rebound. If not, if the economy continues to slow, we think there's a reasonable chance that markets would need to come down a little bit, stock markets. And we don't know which one of those is more likely, because again, that would involve trying to predict Donald Trump. But we do think maybe there's a few reasons to be a little bit cautious right now, if that makes sense. But despite having short-term caution, we're still pretty optimistic about long-term returns, and I'll explain why. So whenever we do a presentation, certainly whenever Colin does a presentation, we usually have a Warren Buffett quote. I also like to quote this guy, Benjamin Graham. Benjamin Graham wrote the book that inspired Warren Buffett. So a pretty good person to listen to. And he said, in the short run, the market is a voting machine. But in the long run, it's a weighing machine. And I think this really speaks to me. So if you think about how a stock market works, it's a load of people voting, if you like. It's lots of institutions and investors saying, I am willing to pay this to buy that stock. I'm willing to accept this to sell that stock. And you basically, the market just collates all of that data and that sets the share price. So that's all the market is. But because most of those investors are human, not all of them, but they react to news flow, react to sentiment, react to even emotions like fear and greed, and even the algorithmic traders, the computerized traders, react to a lot of that stuff as well. So in the short term, markets are really volatile and will react depending on what Donald Trump does. But in the long run, Benjamin Graham says, they are a weighing machine. All that matters for a company's share price over the very long term is essentially what profits it makes and whether those profits are going to go up or down over the long term. And then for us as investors, what price did we pay to buy the stock in the first place? And the good news is, for most of the asset classes that we invest in, there is some sort of fundamental indicator we can look at that should give us a good idea of what returns we might expect over the long term. So take the simplest asset class we can find, apart from maybe cash, and that's gilts. So when you buy a gilt, what you're doing is you're lending money to the UK government. That's all it is. And in return for that loan, the government will pay you a fixed level of interest for a fixed period of time. So let's say 10 years. And that means when you buy a gilt, you know exactly what your return should be if you hold it to maturity, because you know what your interest is going to be, you know when the loan is going to be repaid, and you know how much loan will be repaid. So all of those things. And by the way, it's absolutely guaranteed by the government. So we can calculate the yield on a bond, which is essentially the same way as saying the return if you hold it to maturity. There's a 100% correlation. So we know exactly, if we buy a gilt, hold it to maturity, what return we're going to get. Unless, of course, the government defaults on its debts. It's never happened yet. Other countries have. Never lend your money to Argentina is probably a good lesson to live by. So that applies if you buy one gilt and hold it to maturity. We don't tend to do that. What we'll tend to do is we'll buy a basket of gilts, an index, for example, but the same principle still applies, essentially, and that's what we're looking at on this chart. So if you've seen me present before, you know I love a scatter chart. Now, these can be a bit daunting if you're not used to them. I think they're a good way of comparing kind of the relationship between two different things. So I'll talk you through it. So each dot on this chart is a different 10-year period for the gilt market in history. And the higher the dot is on the chart, the higher the returns were over that 10 years. So these dots up here saw a 15% per annum return from gilts. That would be pretty nice. These ones down here at the bottom saw basically nothing return. And then across the sort of horizontal axis, across the bottom, is you've got what the yield was on the 10-year gilt at the beginning of the 10-year period. And what you can hopefully see is the dots form a sort of fairly clear pattern from bottom left to top right, that basically, if you buy a gilt and the yield is low, you'll end up with a low return. If you buy a gilt when the yield is high, and you'll end up with a high return. It's really simple investing, isn't it? There is some variation around it, but you can see a pretty clear pattern. There's like 96% correlation between these two things. The current yield, which I've marked with a sort of vertical black line, is 4.75%. So give or take, if you're willing to take a 10-year view and lend your money to the government, you're probably going to get somewhere in the region of 4.75. You might get slightly more or slightly less, but it's going to be that sort of region with a pretty high degree of confidence that that's going to be the case. So that will be all right for a fairly low-risk kind of approach. If you want to take a bit more risk and take a bit more return, get hopefully a bit more return, you can, instead of lending your money to the government, you can lend your money to a company by buying a corporate bond. And these work in exactly the same way, except, of course, if you lend money to a company, there is more risk of them defaulting on that loan. But when we look at these corporate bonds, these are really safe, secure companies with very strong credit ratings. Because they are riskier, you get a higher return. If you lend money to a company right now, a typical company, you get a 5.8% return, a lot more than you would get from gilts. So this chart is basically worked in exactly the same way as the gilt chart we looked at, but this time each 10-year period is for the corporate bond market. There's a bit more variation around it because it is a riskier asset class, a bit less certain, but still the same pattern applies. If you buy when the yield is low, you get a low return. If you buy when the yield is high, you get a high return. Right now, I say 5.8% yield. Now, often you've got somewhere between about 5 to 7% return over the long term when yields have been at those sorts of levels. So, again, that would be pretty decent for a relatively low-risk asset class. So what about the stock market? Well, we can do something similar for stock market. There's a few different ratios we can look at. One of our favoured is called the price-earnings ratio. And this looks at the relationship between a company's profits and its share price, essentially. So if you imagine you had one company that was worth £1 billion, let's say there was 1 billion shares on the market, and they're worth £1 each, that gives it a market capitalisation, that we call it, of £1 billion. And let's assume that company makes £100 million a year profit consistently. That gives you a price-earnings ratio of 10 times earnings. If you take 1 billion, divide it by 100 million, it gives you 10. So the company is valued at 10 times the annual earnings it's expected or that it produces. And that can often be a good guide to returns. To put it a different way, if you imagine that company continued to make 100 million a year and paid it all out to shareholders, it would take you 10 years to get your money back based on what you bought to buy the company or buy the stock. It does also reflect some future growth expectations, because you might be quite happy to pay 25, 30 times earnings for a very fast growing company, but if a company is not growing its profits at all, you probably don't even want to pay 10 times earnings for it. But if we look at the market as a whole, well, obviously for the market as a whole, we don't know what's going to happen to earnings in the future, but we do know what the current earnings are, and we do know the current price. And typically, the price-earnings ratio of the market has often been a very good guide to future returns. So this is looking at the US stock market. That's the one that we get the most queries about. It's also one of the ones where this relationship holds the strongest. There's about an 80% correlation between the price-earnings ratio and the returns. So this works the same way as those gilt charts, but this time each dot is a different 10-year period in history for the US stock market. So the higher the dot, the higher the returns. The only difference is across the bottom, we've got the price-earnings ratio at the beginning of the 10 years. So essentially what it means is that the line slopes the other way. Generally, if you buy when the price-earnings ratio is low, you get a high return. And if you buy when the price-earnings ratio is high, you tend to end up with quite a high return. And again, there's some variation around that, but there's a reasonable degree of correlation. Current price-earnings ratio is 27 times. That's quite expensive relative to long-term averages. Normal average is about 17. If we sort of circle all the dots, which have been similar to that, a bit lower, a bit higher in the past, you can see the sort of highest one we can see on there is about just over 5% per annum. And then most of the others have been lower than that. There's even 2 or 3 that are actually below 0. So it's rare that you get a negative return on the stock market over 10 years. Where they have happened, it's been where they've been quite expensive. So we can sort of say our sort of best guess for returns for the US market, again, if history is repeated, might be at best just about 5% or slightly more, but there's a reasonable chance that it might be lower than that. Other markets might look better. We do this for all the different equity regions, and there are other ones we think look better than that. We look at all the different types of bonds, and we look at things like property and infrastructure. And for most of those, there is something we can use that has historically given us an idea of what returns will be in the future. And what we do is we use all that data, all that evidence to try and create an asset allocation, a mix of assets that we think will give us the best chance of achieving the kind of the target returns of the portfolio, but importantly, at the lowest risk, or probably to put it a better way, at the highest degree of confidence. So what mix of assets give us the most confidence of getting that returns? So if you look at the 2 of the asset classes I mentioned before, corporate bonds, I said I thought could do between maybe 5 to 7% per annum, with a reasonably high degree of confidence, and that US equities we thought might do 5% per annum, but a lot less confidence about it, a lot more risk around that. Then our model would say put a bit more in corporate bonds and a bit less in US equities. Not avoid it completely, but just skew the portfolio that way. So that's how we kind of create the long-term asset allocation. And then we tweak that based on what we think is happening in the short term. And this comes back to opinions again. Because every week, as an investment team, we sit down and we ask every member of the team to say, what do you think? What's your best guess? And it is a guess. We're back in the realm of opinion. It might be based on data, but it's a guess. What's your best guess for what the returns might be for the next 2 years for each of the asset classes? And then we also say, well, as well as that, what's your best guess for returns if everything went really well for that asset class? If all the things really went for it, what returns might you get? And then what's your realistic worst case scenario for that asset class? And I don't mean by that nuclear war where nothing's worth anything. What I mean is a realistic kind of worst case scenario. So if we take these 2 asset classes here, defined returns and equity. So equity, our best guess, the number in the middle, is about 9.5% per annum over the next couple of years, by maybe positioning slightly away from the Magnificent Seven and the US big tech stocks. We think perhaps returns might be more volatile in the short term, but perhaps might then recover. But again, that's just an opinion. The team also thinks there is a possibility that we could get, and this is the top of the bar here, about 20% per annum, if, for example, all those tariffs are cancelled, if economic growth was way better than expected, you could realistically get much better than that, maybe as high as 20%. But on the other hand, if those tariffs are set at those higher levels, if the economy really struggles, we could lose quite a bit of money on the stock market over 2 years, maybe even minus 10. So the stock markets are inherently uncertain in the short term. Long term, they're a bit more predictable, as I said. You compare that to defined returns. Now, defined returns, we think, could give a return of about 12% over the next couple of years. We'll explain why shortly. If stock markets go down, because they are linked to the stock market, defined returns would probably go down as well. But generally, our experience is they tend to only go down about 80% as much. So there's slightly less downside. So when we'd look at this, by the way, there is less upside, which we'll explain in a minute. But when we look at this, we look at the two different asset classes and we say, based on these, defined returns in our view has got a higher expected return and there's more certainty around that return because we've got a lower bar, a shorter bar. And therefore, our model says, at the moment, we should have a bit less in equities and a bit more in defined returns.